Welcome to the deep dive video update. This is a weekly video that I do where we have to look deeper into the charts because I was not using them in the daily videos. Their messages are not really blatant right now, but we can still get some clues by looking at these in a deeper way. I also have some other charts that I show here that are unique just to this video, including some new charts that I haven't included in the past. This is being prepared for Monday, March 17th. This first chart I show every week. It's just for information. It's just for this particular video. This is a long-term range of the VIX, and we're still in a lower range over on the right-hand side. Even though the VIX is above 20 currently, it's coming down, but it got even higher up into the 20s as the S&P has been going down. And we are going up a little bit here, but we haven't really switched over to a higher range yet. It'll take some time for that to work out. So we're keeping an eye on this. We could switch up, go above this red line, above 20 overall, if we switch to an even more negative environment than what we're seeing right now. But according to this, it's not really being reflected that way in this particular chart. Also, this comes in and out of the daily video on an as needed basis. The VIX, this measures how fast the VIX is moving. And we spent a number of days up here at the 70 or above level. That's when the VIX has been going up quickly. Well, since the VIX has been coming down, we're also coming down with the momentum of the VIX. And currently, we're just about at the midpoint. This is another study of the VIX. It looks at the correlation between the VIX and the S&P 500. Even though the S&P has been going down, the correlation here is also quite low. It means they're going more in lockstep with each other. When we get concerned is if we go above this dashed line, that means they're getting out of line with each other and seeing some fear that may not be reflected in the VIX itself. Well, we're seeing plenty of fear in the VIX right now, so this chart really hasn't given us any additional insight lately. This is the VIX, and then we do a ratio with the VVIX, which is the volatility of the VIX, or the VIX of the VIX. And as the VIX has been going up, this has been going up too, but we're still pretty much range bound overall. We haven't really seen any true conviction. When this chart is more useful is when we're either really going up or really going down with more of a trend. We've been range bound here for the last few years. Then this was in the daily video for a couple of months. It's a variation of the VIX called the SKU Index, which is calculated in a slightly different way. And when we get up into this red area, the market is expecting some kind of a big move. We don't know if that's an up move or a down move because there are out of the money options, either above or below current price, that may be purchased at any given time that's anticipating either an up move or a down move. Well, we dropped down out of this red area and we're continuing to fall right now. So we're not getting any real extreme reading currently with this chart. Then we look at the volatility of stocks, that's the VIX, and the volatility of bonds, that's the move index, and then do a ratio. And when this is going up, that means that the volatility of stocks is outpacing the volatility of bonds. Bonds, for the most part, have been going up in price, down in yield, even though we saw a little bit of shift this past week. But this just means that stocks are more volatile these days. And I mainly follow the red line overall, and that's starting to go back up. And this is usually in every daily video that I do, but I stopped using it because we're underneath the 200-day moving average when we look at large cap growth. This is an area that's really been getting hit. In a more solid environment, we would be above all these moving averages and actually going up. And that's not what we're seeing right now. And that's causing some concern to us because we need growth to be able to outperform value. And that's what happens in a more positive environment. If value is outperforming growth, we see what we're seeing now, and this chart really comes down. We look at a ratio between the large caps and the small caps. The large caps here are measured by the Russell 1000. That's kind of equal to the S&P 500. And then small caps are measured by the Russell 2000. And that's an index that we do follow every day. And we can see overall, this ratio has been going up as the large caps, even though they've been getting hit, small caps have been getting hit even more. And that's why we see this ratio going up. It's pretty much the story that we've seen, and we're getting enough information from our other charts to show us that the small caps are weak. And then we focus more on the large caps with other charts. And this is for informational purposes. From the low set in October 2022 up until Friday's high, we're still up 61.36%. And then we set another significant low in October of 2023, and we're still up 37.41% from that low. Then technical alerts, if we had an up day, this tended to be blue or green. If we had a down day, it was red. We start at the bottom, that's Monday, and then we work all our way through into Friday with gold finally getting back above $3,000. That's an all-time high and a major mental level for gold. But we can see here that on the down days, we see a lot of red signals being generated. We did have a nice little bounce on Friday, and it shows a little bit of an improvement with the technical picture, and it was being picked up by these alerts. Then I have 6 indexes that we follow, and they're all looking pretty bad right now. And they're scored on a scale of 0 to 100. Coming in first place this week is the Dow, and it's under its 200-day moving average right now, and coming in with a very abysmal 33.6. But it's still the best looking chart from a technical analysis perspective. Then in second place is the S&P, which is holding up a little bit better because there's value inside of the S&P 500, but still it's coming in very low at 31.5. Then in third place are the QQQs, and this is pretty much all growth. These are the big mega cap stocks, which are also included in the S&P 500 and to a degree in the Dow. They've been getting hit hard, but still overall, we're getting a score of 23.5, which is very bad, but it's coming in third place. Then we have the NASDAQ composite itself, which had been doing better. And actually, for about the last half of 2024, the NASDAQ composite was actually outperforming the NASDAQ 100. Well, not now. It's coming in with a score of 19.8. Then we have the mid caps, also looking a little weak these days, coming in at 14.3. And the small caps, which should be to the moon by now, actually, they've gone the other way. They're coming in at 7.9. I've never seen something go all the way down to zero. That'll be interesting to see if that ends up happening. But yeah, small caps have been really disappointing. Then a short-term chart, it first starts with a rainbow going from 10 periods up to 50 periods with a simple moving average. And then the color has changed just to make it look kind of nice and everything. And we can see that we're below all the lines in the rainbow, and the rainbow itself is rolling over and starting to go down. And that just means that we're now in a downtrend when it comes to the short term. And then we look at the advanced decline ratio based on 19 periods, which is more short term. We're actually looking a little bit better. We're still holding up okay on the weekly chart, but here on the daily chart, we're seeing a little bit more weakness. We're below zero, even though we bounced up based on price, and we're also bouncing back up, but below zero based on volume. Intermediate term rainbow goes from 50 periods up to 100 periods. We're below the 50 period moving average, which is the line in the sand between positive and negative in the intermediate term. And we're coming down here, and the farther we go down and the longer we stay below all these lines in the rainbow, the more they're starting to roll over as well. Then another momentum oscillator is the Connors RSI, and this is used like a regular RSI where we look for an extreme positive or negative reading. The intraday movement in this chart is really pretty spastic. If we have an up day, it tends to go above the midpoint. A down day, it goes below. It's when we look for extreme readings. That's when we use this overall indicator. Then this is a new one called a bow tie, and it's a variation of the rainbow chart that I just showed, where we have a short-term moving average in green, and then a little bit longer, and then a little bit longer. And when the green is above the red and is above the blue, that's an uptrend. What we're seeing now is the green is under the red and the blue as we've been in a more shorter term downtrend. So this just gives us another visual look at what is the trend actually doing. And when we're positive and then starting to go negative, we'll see the lines all cross over each other and actually start to head down. And this is just suggesting that the short-term trend is, and even intermediate term trend is negative. Another one just shows us in another graphical way, are we in an uptrend or a downtrend? whenever we are in an uptrend, we start with a green histogram here, and the longer we stay in it, the bigger this actual indicator becomes. And then we might have a down period, and then we start over again, and we go up with another uptrend. When we start to go into a downtrend, we drop below, and this actually turns red. So it just gives us some color confirmation of what's actually happening, which we already know this from other charts that we're looking at. So this just kind of confirms it in a different way. This is volatility for the S&P 500 itself. And when this is going up, that usually means that the S&P is going down. When this is going down, the S&P is going up. This works very similar to the VIX. And we're getting a high reading right now because we've been really coming down. And ever since the beginning of 2025, we've been seeing more elevated readings with this. So this kind of goes opposite of what logic might tell you. You would think that as we were going up here, this would go up. That's not necessarily the case. It goes in the opposite direction of price. And we're seeing this really quite volatile currently. And then this is what's the volume. And I play a major role in volume in my analysis. And there's some indicators that I use that are based on volume, but other people that I pay attention to and really respect, they don't think volume really matters because there's still a lot of trades that take place off of the exchange, and that volume doesn't get counted in the daily tally. But when we're above average with volume, we'll see this histogram green, and then Friday, and that's a little bit of a concern. We had a really nice bounce up, but we were below average with volume. Now that's the negative side, and that's kind of a classic technical analysis negative divergence. When you see a move down on above average volume and then a counter trend bounce up on below average volume, that's considered a negative divergence. However, the volume that we saw on Friday was about 90% of it was up volume, meaning that folks were coming in and buying, and that could be positive. That's usually how something like this starts when we begin to go up because there's a lot of pessimism right now. Sentiment is very negative as we've been going down. Everybody thinks the market's just going to automatically go down. That's usually about the time it bottoms and starts to go up. And then when we finally keep going up a little bit, then everybody starts to jump in, and then the move might be about over by that time. So there's a positive side and negative side with this particular chart. It's negative because it's below average, but it's positive because in different charts that I show, it shows that most of the volume was to go in and buy. Then the percent from the closing high, this is a variation of the chart, different charts that I show, but when we set the all-time high back in February, how far are we away from that right now? And this also kind of goes a little bit counterintuitive, where when we're getting further away from the recent all-time high, this line actually goes up instead of down. And we got close to that 10% level on a closing basis. I tracked this on an intraday basis. So I went with the intraday all-time high and then the intraday all-time low, or at least the recent low right here, to measure what percentage are we away. Because when we get to 10% or greater, that marks a correction. And that's when a lot of things shift over. A lot of money management systems kick into a different gear and they get more defensive, and the market is actually turning more negative. Well, we spent a little bit of time right at that 10% level, and we were close to that last August. And this is when the smart money started to come in and do some buying. Is that what we're seeing right now? We got close to this 10% level. We saw a nice solid 90% up day in Friday's session. Are we going to be able to see this continue to go back up? Then this is a chart that's been coming in and out of the daily video. It's whether we're above or below the 200-day simple moving average. I stopped using it in the daily video because we're below it, and I probably won't show it again unless we get back above it. But for the last few years, we've been green, which means above the 200-day moving average. Now we're turning more negative. Now, the way I measure the long-term trend is up here is a 50-period moving average in blue, and then a 200-period moving average in red. And quite honestly, the way I do longer-term investments, is if the blue line's above the red line, I go long. That means the long-term trend is positive. But there's also another aspect to that. Are we above or below the 200-day moving average? Well, we had been above it for a long time. That's why we're seeing green here. And we're also in an uptrend. So we have two criteria for the long-term trend. Now, one of those criteria has actually turned negative because we've fallen below the 200-day moving average. And then in the program that I teach is that, okay, when we're going up and then we start to go down, I really implement hedging. And so there's really no need for anybody to ever lose money in the market. You might go through periods of time where you don't make any money, but there are very simple tools that you can implement that allow you to hedge so that, okay, I didn't make any money during this time, but I didn't lose any either. And that puts you in a completely different time frame and mental frame too, because now you can just sit back and observe what's actually going on without freaking out, seeing your hard-earned money dripping away with losses and then getting to the point where like I can't take this anymore. Well, if you're interested in learning more about that, check out the link below this video. I have a program. Come and I deal with this and additional videos that I don't post on YouTube or Rumble, and I can try to help you with that if that's something that interests you. Then another newer chart is called a proper order. This is just a variation of what we've already been looking at. And typically when we're in an uptrend and this background area is green, that's positive. Then when we are below the midpoint and going down, that's red, that's a downtrend. So this just gives us another visual confirmation of are we in an uptrend or downtrend? And right now we are in a downtrend. But it took a while for this indicator to actually pick that up because we've been falling pretty quickly and we were breaking through support and it was still picking this up as being positive until we got into the month of March. CMB composite, this is a chart that I usually show in this video and sometimes in the daily video. This is an oscillator. We look for an extreme positive or negative reading. We're not getting either right now. This also was one that I was using a lot in the daily video. These are anchored moving averages, which are different than regular moving averages, which calculate the periods like a 10-period moving average and then divides by 10, and that's your current value. And then the next day, it takes the next 10 periods, dropping off day number one and adding day number 11. And from that, you get a moving average. It's an average that moves with price. Well, when you set up these anchored moving averages, they actually project forward. You click this based on some kind of a significant high or low, and then it shoots forward. So these lines are already on the chart before we even get there with price. Now, I was really focused on this light blue line here because this was going back to a significant low that was set in April of 2024. And then we had a nice little bounce up out of that. And so we held on to that area for a while, but now we broke below it. Can we get back above it? And another issue is if we do start going back up, all these other anchored moving averages right here, they may provide overhead resistance because what was once support now often becomes resistance. So if we can break through this blue line, if we keep going up, that would be more positive, and then the orange line and the black line. Now, if we keep going down, there's another purple anchored moving average here going all the way back to a significant low set in October of 2023. That's the one that I measure near the beginning of this video. And that was pretty important. If we continue to fall, we'll be seeing if this purple line ends up providing some kind of support. Then the Bollinger Bands, and I did use this a little bit when we were moving very quickly, and there's lots of different ways you can implement Bollinger Bands. The one way that I implement them here is called the percent B indicator, and it's whether we close above or below the upper or lower Bollinger Band. And we actually closed below it a couple of times, and that's why we were getting extreme negative readings here with the percent B indicator, because this doesn't happen all that often, either positive or negative. And when it does, it tends to not last very long. And then something's going to have to change where the price is going to have to go in the opposite way to turn to wear off this extreme reading, or price is going to have to move, or the Bollinger Band itself is going to have to move, or a combination of those two things. We're not outside, or at least beneath the lower Bollinger Band right now, but we were earlier on as we were really going down. Then we want to keep an eye on the S&P 100 because it's the biggest stocks that make up the S&P 500. And It's been underperforming because there's ratios that we show on different charts here, but we're not really seeing anything all that strange when we just look at the chart pattern itself. And this did come in and out of the video from time to time. In fact, the weekly version of this chart is in this week's weekly video. This is a point and figure chart. This doesn't take time into account. It just takes price movement. And when we move up by a certain amount, an X is drawn. When we go down by a certain amount, an O is drawn. And right now, after Friday's session, we're not seeing anything new drawn into this chart. The current pattern is a double bottom breakdown that was generated on February 27th. And that's when we broke below all of these X's and O's in here, and that started to turn things more negative. Then a long-term rainbow goes from 50 periods up to 250 periods, and we're even falling below that right now. We've come well down below the 200-day moving average. We'll see. The longer we stay down here, the more these lines are going to roll over, and that's going to show more damage to the long-term trend. But this has happened pretty quickly. So even though the lines are starting to move, they're not really bunching up all that much yet, other than at the very top end of the rainbow. Then Germany's been doing quite well lately, and this is a weekly chart of the German DAX. The S&P has not been doing very well lately, and it's been going down, and it's showing now that the correlation between US stocks and German stocks are more neutral, where usually they have a pretty high degree of correlation. Then some different support and resistance areas. This is a mini rainbow. It's a 20 period simple moving average of the open, high, low, close. We're well below the rainbow. The lines are coming down. And so it's like, okay, I don't need to show this in the daily video because we have other charts that show us how negative things are at the present time. This is an Ichimoku cloud. I showed this for quite a while here. There's also some studies on here. The blue line is below the red line. That's negative. The green line's been coming down. That's negative, even though we did bounce up. This is short term with the green line, but we've fallen below the cloud currently. Now, if we do start to go back up, will this cloud provide overhead resistance at some point? We don't know that. This is just something that we'll be watching. Then broad market measure, this is the VIXN, which is the NASDAQ 100 equivalent of the VIX. And it's been going up a lot lately too, as the NASDAQ 100 has been under pressure. And this is the chart of the QQQs, which is the ETF for the NASDAQ 100. We're below all the moving averages here. This is a 200-day moving average. And in fact, the 20-period moving average, which is short term, is now crossed below the 50-period moving average, which is intermediate term. So yeah, a lot of technical damage has been done. Then we look at the S&P 500 on top, and then a ratio of the Qs, which is growth, to the diamonds, which is value, even though there's some tech stocks that are in the Dow. And we see that there's kind of a strong correlation between the two, but it's actually been coming down just a little bit as we've been seeing value outperforming growth. Keep an eye on the transports, which are just doing not very good right now. That's the red line. And then we compare it to the Dow, which is the black line, which is also not doing well, but you can see the transports have been even weaker. Then we want to keep an eye on the financial sector in general. And I show the financial sector chart in a daily video. And it's still in an uptrend, but it's underneath its 50-day moving average, but still above its 200-day moving average. Well, then we want to keep an eye on the smaller banks, the regional banks, like Silicon Valley Bank, Republic Bank, New York Community Bank. Are there going to be more banks that come out and say that they're having some problems? And that's why we watch this. And we watch the regional banks and do a ratio with the financial sector. And the regional banks have been under pressure. They've been starting to underperform, and we're actually in a downtrend with this ratio. And then here's the bank ETF itself, where we're underneath the 200-day moving average. Now, it's still in an uptrend because the blue line's above the red line, but it would be more positive, first of all, if we could get back above the 200-day moving average and then eventually the 50-period moving average. But the longer we stay below this, the more we're in danger of actually seeing this turn into a downtrend. Rate of change chart here, this goes back 250 periods, and this is very long term, and I just use it for information. This has been coming down as we've been under pressure. Keeping an eye on bonds, and when this is going up, what this measures is cash to 3 to 7 year bonds. And when this is going up, that means cash is actually outperforming. It'd be better to keep cash in your pocket than to go out and buy a 3 to 7 year bond. And when this is going up, that means cash is outperforming. Well, lately it's been starting to come back down. And that means that maybe some of the uncertainty about inflation and interest rates is starting to wear off. Now, everybody's freaked out about it, and the CRB index is in uptrends, and there's these concerns that we're going to head into a recession, and all that might happen. But when we look at this chart, we're actually seeing the fear coming down when we look at this particular ratio. We do that same basic logic here with tips. That's they adjust for inflation and interest rates. And when folks are worried about that, the tips will outperform. And that's what we were seeing at the beginning of 2025. Now we're seeing things actually start to turn and go down. Could that be that the market's not as concerned about inflation right now, even though a lot of folks are talking about that and they're just totally dogmatic saying that we're going to have hyperinflation and we're going to go into a recession? That's not what the market's saying right now. Now, this could change at any time, and the market may agree with that, but I prefer to go with what the market is telling us rather than just coming to some kind of a conclusion that's not necessarily based on what we're really seeing in the charts. Then, this is that same basic idea. We had been really going up. That means there were inflation worries and interest rates were going up. This is starting to come back down. Well, if this could continue to go down, that would be more positive. And we look at the long-term bond, that's the blue line here, and then the red line is the S&P, and it's been really under pressure, and even the long-term bond has been coming down. Then we look at a long-term correlation, which is actually showing some weakness. The short-term correlation based on 10 periods was getting stronger. Now it's starting to show a little bit of weakness as well. And I do a lot of studies that show the interplay between stocks and bonds because that can give us some clues sometimes as to what will happen with the S&P 500. We do that same basic thing with the QQQs to the long-term bond ETF, and this long-term correlation is actually getting a bit weaker as well. And we take the 10-year yield in America and subtract the German 10-year yield, and this has really been coming down because German rates have really been going up. And because of this whole Russia-Ukraine thing and the EU saying, okay, Zelensky will come in, we have your back. If Trump's not going to help you, maybe we will. Well, the German market, stock market has been doing okay, but their interest rates are also really going up right now. And that's why we're seeing this really coming down, because that means that the German rates are going up as the US rates have been going up as well, but the German rates are going up even faster. And then down in the middle, we can look at the interplay between interest rates and the dollar. This is the US dollar index here, and we can see that there's a pretty high correlation between the top chart and the middle chart. And so we're not seeing anything all that strange, but I just wanted to explain why this is really coming down right now. And then we keep an eye on the 2-year yield and then compare it with what's going on with the S&P 500. Not anything showing too much of a conviction currently. Then here's another look at the European stocks, and we compare them with 3 to 7 year bonds. When this is going up, that means that the European stocks are actually outperforming, and that's what they've been doing. And then we want to keep an eye on the yield curves, not so much this one. This is the 10 to the 2 year, and this is what most folks follow. And we're still above the zero line, meaning that we're not inverted, where we had spent a few years in there being inverted. What's causing us a little bit of concern is when we look at the 10 to the 3 month yield curve, not as many people follow that, nor do they think it's as important. I follow both because there are some economists that I actually pay attention to and respect just a little bit, and they like the 10 to the 3 month yield curve. And this has gone back to being inverted right now. And then if it goes back and stops being inverted, that usually begins the countdown to see, are we going to go into a recession? Now, we were inverted for quite a while here. We came out of that, and to this point, we have not gone into a recession, but there's a lot of fear that we're going to. The Personally, the real key thing to watch is interest rates and watch the employment situation. It's still pretty strong right now. As long as employment holds up, we might be able to avoid going into a recession. If that really starts to break down, that's going to take the rest of the financial markets with it, probably. Then this is a variation of a different chart that I use in pretty much every daily video. What are the percent of stocks in the S&P 500 above their 200-day moving average? And we saw that drop below 50. And I did start using this in the daily video for a while as we were dropping below 50. And that just means we're more negative right now, since there are fewer stocks above their 200-day moving average than there are below right now. And then what about the 50-period moving average study? This is for the S&P, also below 50, and the mid caps well below 50, and the small caps even further below 50. Now, if we continue to fall, this is also set up to be like an oscillator. When we get an extreme positive or negative reading, we're kind of getting close here with the small caps. And sometimes when we get down to this really extreme negative reading, that can produce some kind of a bottom signal that sometimes we're able to bounce up out of. Now, this is just the small caps, and my focus is on the S&P 500, but we'll want to be watching this just to see if something like that, a nice little bounce ends up happening. So thank you. I really hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.